There is a financial maneuver that is perfectly legal, wildly profitable for a small group of people, and almost universally misunderstood by the people it is being used on. It is not a Ponzi scheme. It is not a crypto rug pull. It is not a prop trading firm taking your fees. It is something far more respectable looking, far more normalized, and far more dangerous precisely because it hides inside a press release that uses words like returning value to shareholders. And by the time you finish this video, you're going to look at the phrase share buyback program, the same way you look at a gas station sushi menu. It technically exists. People consume it, and somebody always ends up regretting it. I am talking about stock buybacks, and before you click off because that sounds boring, let me give you one number that should make you sit up straight. Since 2010, S&P 500 companies have spent over $10 trillion buying back their own stock. 10 trillion. That is more than the GDP of every country on Earth except the United States and China. Companies spent $10 trillion, not on workers, not on factories, on their own shares. And the executives who approved those buybacks collected billions in stock-based compensation as a direct result. Funny how that works. So let's start at the beginning, because to understand why this is a problem, you first need to understand what a buyback actually is, and why it was illegal for most of modern history. A stock buyback is exactly what it sounds like. A company uses its own cash to go into the open market and purchase its own shares. When shares get purchased and retired, the total number of shares outstanding shrinks. And when the number of shares shrinks, each remaining share represents a larger slice of the company. Earnings per share goes up. The stock price tends to rise. Everyone looks at the chart and feels good. The CEO gets a bonus. Repeat. Sounds harmless, maybe even smart. And that is the con. Because here is what a buyback is not. It is not an investment in the company's future. It is not new equipment. It is not new hires. It is not research and development. It is not a factory, a product line, a patent, or a customer. It is a company spending its cash to make its stock price go up today, instead of spending that cash to make the business worth more tomorrow. And the reason this matters is because for most of American financial history, this was not allowed. In fact, before 1982, stock buybacks were considered market manipulation and were explicitly prohibited under securities law. The SEC treated them the same way they treated a company executive, secretly buying up shares before a positive earnings announcement. It was seen as artificially inflating the stock price using inside knowledge, which, if you think about it, is exactly what it is. The company knows more about its own financial position than any outside investor does. And it is using that information, plus the company's own cash, to move the price. That was manipulation in 1972. But in 1982, the SEC passed Rule 10b-18, which gave companies a legal safe harbor to buy back their own shares, as long as they followed certain timing and volume restrictions. And with that single regulatory change, the floodgates opened. In 1982, total buybacks across the S&P 500 were essentially zero. By 2018, companies were spending over $1 trillion a year buying back their own shares. By 2022, that record was shattered when S&P 500 companies spent $1.26 trillion in a single year. 1 year, $1.26 trillion, spent not on the business, on the stock price. And if you want to understand exactly how this machinery works in practice, meet Sarah. Sarah is the CEO of a large publicly traded manufacturing company. Sarah's compensation package is mostly stock options and performance share units, which is a fancy way of saying Sarah doesn't get truly rich until the stock price goes up and earnings per share hits certain targets. Sarah's company is having an okay year. Revenue is flat. The business isn't growing fast. If she invests heavily in a new factory, it might pay off in 7 years. But Sarah's options vest in 3, so Sarah has a choice. She can invest $2 billion in long-term capital expenditure that might not show up in earnings for years. Or she can use that same $2 billion to buy back shares, instantly boosting earnings per share because the denominator just shrank, hitting her performance targets, triggering her bonuses, and making the stock jump. Sarah chooses the buyback. Her board approves it. Wall Street calls it disciplined capital allocation. Sarah makes $40 million, and the factory never gets built. This is not a hypothetical. This is the operating model of corporate America. And if you want a real case study that puts a face on the damage, look at Boeing. Between 2013 and 2019, Boeing spent approximately $43 billion on stock buybacks. $43 billion. During that same period, Boeing was developing the 737 MAX, a plane that would eventually be grounded worldwide after 2 crashes killed 346 people, largely linked to a flight control system that investigators found had been developed under intense cost and schedule pressure. In 2019 alone, before the second crash, Boeing's board approved a $20 billion buyback program. After the crashes, after the grounding, after the congressional hearings, it came out that Boeing engineers had raised concerns that were deprioritized, that safety systems had been engineered to keep costs down, that the culture had shifted from one built by engineers to one run by financial metrics. $43 billion went to boosting the stock price. And the question of whether that money could have funded a safer aircraft program is not a theoretical one. It is a very real and very uncomfortable one. And Boeing is not the exception. It is the case study people point to because it had consequences that were impossible to bury in a footnote. But the same dynamic plays out quietly across dozens of industries every quarter. Now here is where the math gets ugly for regular investors, because most people hear buybacks and think, great, the stock is going up, I am winning. And in the short term, maybe you are. But here is what is actually happening underneath. When a company spends its cash on buybacks instead of investment, it is trading future growth for present optics. It is cannibalizing the seed corn to make this quarter's bread look bigger. And when that happens consistently, year after year, across the largest companies in the index, you end up with an S&P 500 full of firms that are financially engineered to look healthy on the surface, while quietly hollowing out their competitive position. Because research and development as a percentage of revenue has been declining in many traditional industries for years. Capital expenditure at many large companies has been consistently outpaced by buyback spending. And the companies that have been the most aggressive buyers of their own stock are often the same ones that later need government bailouts when things go wrong. The airline industry spent roughly 96% of free cash flow on buybacks in the decade before 2020. When COVID hit, they were back in Washington with their hands out within weeks. The government, meaning taxpayers, handed them $54 billion in bailout funds. The same companies that spent a decade saying they were returning value to shareholders turned around and asked those same shareholders, in their role as taxpayers, to cover the downside. And Congress wrote the check. That is the complete architecture of the scam. Privatize the gains during the buyback boom. Socialize the losses when the bill comes due. And here is the historical rhyme that should make you nervous. Because this is not the first time American markets ran a version of this playbook. In the 1920s, companies and their insiders routinely manipulated their own share prices through coordinated purchasing schemes, wash trades, and artificial volume. The goal was the same: make the stock price go up, collect the gains, and let whoever was left holding the bag deal with the fallout. When the crash came in 1929 and Congress started investigating, the hearings revealed a financial system where the people running companies had been systematically using corporate resources to enrich themselves at shareholders' expense. Which is why the Securities Exchange Act of 1934 and the regulatory framework that followed drew a hard line against exactly these kinds of price manipulation tactics. A line that was quietly erased in 1982 with a single CC rule change. What was illegal in 1933 is now standard practice and praised in earnings calls. The vocabulary just changed. Instead of stock manipulation, we call it capital allocation. Instead of insiders enriching themselves, we call it aligning management incentives, same mechanism. Nicer branding, better suits. So what do you actually do with this information? Because knowing the game is rigged is only useful if you know where the exits are. First, when a company announces a buyback, stop treating it as automatically good news. Ask where the money is coming from. If it is coming from genuine excess cash after all investment needs are met, fine. If it is coming from debt issuance, that is a red flag. Companies borrowing money to buy back their own shares are essentially leveraging up the balance sheet to boost a short-term metric. And when rates rise or earnings disappoint, that leverage becomes a trap. Second, look at what management actually owns versus what they are paid in options. Executives who hold real shares alongside investors think differently than executives who collect options that only pay off when the price goes up. The incentive structure tells you more about future buyback behavior than the press release ever will. Third, pay attention to industries with declining capital expenditure. If a company is consistently spending more on buybacks than on maintaining its own infrastructure, that is a business that is choosing to look good today over being good tomorrow. And at some point, the gap between the optics and the reality shows up. It always does. It just usually shows up on someone else's watch. The part that nobody wants to say out loud is this: buybacks are not always wrong. There are situations where a company genuinely has more cash than viable investment opportunities, and returning it to shareholders makes sense. That version of buybacks is fine. That is not what this video is about. This video is about the version where companies cut R&D, underfund pension obligations, skip maintenance capital, load up on debt, and funnel the proceeds into a buyback program timed to executive vesting schedules. That version has cost this country more in lost innovation, degraded infrastructure, and corporate fragility than any single recession in the last 40 years. And the reason you have probably never heard it framed this way is because the people who benefit from the current system are the same people who fund the think tanks, sit on the boards, and appear on financial television explaining why buybacks are good. Actually, so I want to hear where you land on this. Do you think buybacks are fine and efficient? Just capital going where it does the most good? Be a genuine structural problem that has quietly weakened American corporate competitiveness? Or C, not the root issue, just a symptom of a broken executive compensation system that will keep finding new ways to extract value regardless of the rules? Drop your take in the comments, because the answer is not as obvious as either side wants it to be. And if someone in your life is still treating every buyback announcement like it is unambiguously good news for their portfolio, do them a favor and send them this video, because the line between returning value to shareholders and looting the future to pay for the present is thinner than any earnings call is ever going to admit.